You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. PurePoint advances discoveries through strategic partnerships, working alongside industry leaders, including IsoEnergy, Cameco, Orano, and Foreign Mining. Drilling is underway right now. And now, your host, Chris Frostad.
It's February 3rd, 2026, and this week on Uranium Spotlight, the spot market surges on aggressive fund buying, fresh confirmation that global uranium supply remains constrained, rising geopolitical pressure on Western fuel access, and IsoEnergy completes a major financing as capital moves decisively into the sector. The uranium spot market experienced a sharp repricing last week, driven by aggressive buying from financial players. Spot prices opened the week at $87.15 a pound and climbed steadily to close at $98.60 a pound, briefly trading through the $100 mark along the way. This move was led by concentrated fund activity, with Sprott once again acting as the primary buyer. Purchasing was persistent and price insensitive, quickly absorbing available offers and forcing prices higher. As buying progressed, sellers stepped back rather than meet demand, highlighting just how thin the spot market has become. A review of spot market behavior over 2025 helps explain why last week's buying produced such an outsized response. Throughout the year, spot transactions increasingly occurred during periods of stress rather than surplus. Liquidity was episodic, volumes were inconsistent, and each wave of buying left fewer pounds available for the next. By the end of 2025, the spot market had shifted from a balancing mechanism into a pressure point, exposing underlying scarcity. Against that backdrop, when fund buying returned last week, prices did not drift higher, they reset. The long-term price remained firm alongside the spot move, reinforcing that this was not a speculative spike, but a reflection of tightening physical conditions. For investors, the key takeaway is that financial buying is now colliding with a structurally constrained spot market, creating the conditions for rapid and discontinuous price moves. Updated production results and guidance from the world's largest uranium producer, Kazakhstan, reinforce just how little flexibility remains on the supply side. Final output for 2025 landed near the low end of already reduced expectations, and new guidance for 2026 points to only modest improvement. Even with incremental gains expected this year, production remains well short of what would be required to meaningfully narrow the global supply gap. Years of underinvestment, operational constraints, and long-term contractual commitments have left no obvious source of rapid relief. What stands out is that these are not temporary issues. They reflect structural limits on how quickly supply can respond, even at much higher prices. For investors, this matters because it confirms that higher prices are not a cure for the shortage. They are the result of it. In Europe, draft proposals advanced last week aimed at banning imports of Russian nuclear products, including uranium and nuclear fuel. While timelines remain uncertain, the policy direction is clear and would further fragment an already divided global fuel market. Russia plays a significant role not only in uranium production, but also in conversion and enrichment services tied to materials sourced elsewhere. Removing that pathway forces European utilities to compete more aggressively for alternative supply, much of which is already committed. With virtually no domestic uranium production, Europe faces a difficult reality. Fuel costs represent a small portion of reactor operating expenses, which means utilities are likely to prioritize availability over price. For investors, this development accelerates the shift from price-driven procurement to access-driven procurement, increasing the value of secure, Western-aligned supply. India and Canada moved closer last week to finalizing a multi-billion-dollar uranium supply agreement spanning the next decade. The deal reflects India's expanding reactor fleet and its desire to lock in reliable supply well ahead of future demand. For Canada, the agreement reinforces its role as a critical supplier, but it also highlights the limits of available export capacity. Each long-term commitment reduces flexibility elsewhere, particularly as Western allies compete for the same material. For investors, this matters because future supply is increasingly being allocated quietly today, leaving future pounds available to balance the market later. Security risks resurfaced last week in Niger following an armed attack near the capital's airport, where seized uranium material has reportedly been stored. While the incident was contained, it underscored the vulnerability of supply chains in politically unstable regions. Even without direct production losses, events like this raise concerns around transport, custody, and jurisdictional risk, further narrowing the set of acceptable suppliers. For investors, this reinforces the premium placed on stable jurisdictions and delivery certainty. IsoEnergy completed a substantial financing last week, raising more than $80 million through a bought deal and a concurrent strategic private placement with NextGen Energy, which maintained its approximately 30% ownership position. The capital provides IsoEnergy with flexibility to advance development and exploration across its portfolio at a time when access to funding is becoming increasingly selective. For investors, the key takeaway is this. As the uranium market tightens, capital is consolidating around companies with scale, strong assets, and credible long-term partners.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors affecting the uranium price. Join us again next Tuesday on Uranium Spotlight.